If you're just starting to invest, there are some mistakes you do not want to make because they could cost you thousands of dollars, or worse, even wipe out your gains entirely. This video is your roadmap that you need to avoid costly pitfalls and get started building real wealth. By the end, you'll know exactly what to do as a beginner investor, and more importantly, what not to do. So, what are the 7 biggest missteps many investors make right out of the gate? What's the most common stumbling blocks that trip up even seasoned market participants? We're going to find out right now. These are common mistakes, meaning many people make the same mistakes. Why? Well, because at some point they seem to make sense. They seem like the thing to do. We either assume that they make sense or we pick up bad advice from others. Either way, they can wreck your progress, hinder your goals, and wipe you out. They are bad news. But there's good news. I've already made these mistakes and now I know better. I can teach them to you so you can avoid them if you know what to watch out for. You can save yourself lots of headaches, lots of time, and lots of dollars. Today, we're breaking down the top 7 rookie mistakes that can cost you thousands.
Working while you do less. Stay lazy, let your money do the rest. The lazy investor.
What's up, everyone? Welcome back to the channel. I'm Paul Cox, the Lazy Investor, and my goal is to make investing simple and accessible. If you are an entrepreneur, if you want to retire early, become wealthy, gain financial freedom, invest in your future, learn everything you need to know about investing, about crypto, about real estate, about consistent, automatic, regular investment strategy. If you want to build a diversified portfolio that pays, you have stumbled onto the right channel. I show you how to be lazy and let your money do all the work. My goal is to teach you how to be wealthy in 5, 10, 20 years. I'm here for your future. So lock it in, click the clickety-clicks, subscribe, and like the video. I am about to deliver the breakdown on the top 7 mistakes rookie investors make, and more importantly, how to dodge every single one. If you're serious about building wealth without wasting time or money, you're going to want to stick around for this. Let's get into it. Let's jump in and make your money work for you. Mistake number 1, not having a clear, well-defined investment plan. It sounds simple, almost too obvious, but it's the bedrock of successful investing. Investing without a plan is like building a house with no blueprint. Imagine trying to construct a building without any architectural design or structural guidance. You end up with a mess, a jumbled collection of materials, and wasted money. The same holds true for your investments. So, first, define your goals. What are you trying to achieve with your investments? Are you diligently saving for a down payment on a house, that dream home you've always envisioned? Or is your primary focus long-term retirement security, ensuring a comfortable and worry-free future? Perhaps you're seeking to generate passive income streams, supplementing your current earnings with dividends or rental income. Each goal needs a different approach, a tailored strategy designed to maximize your chances of success. Decide how much you'll invest regularly. Determine an amount that fits comfortably within your budget and stick to it, because consistency is absolutely key to building wealth over time. Small, regular investments add up significantly thanks to the power of compounding. Know your risk tolerance. This is crucial. Are you okay with the inevitable ups and downs of market, the occasional periods of volatility? Or do you prioritize steady, predictable growth, even if it means potentially lower returns? Your plan keeps you focused and grounded when hype or panic inevitably hits the market. It acts as a filter, helping you ignore the noise. When friends start hyping the latest meme stock, the one that's supposedly guaranteed to make you rich overnight, your well-defined plan helps you confidently say no, protecting you from impulsive and disastrous decisions. Remember, every single financial decision you make should move you closer to your overarching financial goal. Without a plan, you'll find yourself constantly reacting to every sensational headline and every fleeting tip, ultimately leading to poor choices and missed opportunities. So, take the time to write down your specific financial goals, establish a realistic timeline for achieving them, Carefully assess your risk level and determine the types of investments that align with your objectives and comfort zone. This seemingly simple step transforms you from a mere gambler blindly chasing returns into a strategic, informed investor making calculated decisions based on a well-thought-out plan. And when the market inevitably gets rough, as it always does from time to time, your plan will keep you calm, focused, and on track, preventing you from making rash decisions driven by fear. It's your anchor in a sea of constant noise and uncertainty, providing stability and direction. So, don't skip this crucial step. As obvious as it seems, your future financial wealth and security depend heavily on it. Start today, right now, with a plan, even a simple one, and you'll avoid the vast majority of rookie mistakes that plague so many new investors. Hopefully, with my help, you'll avoid all of the missteps. Now, let's move on to the next big pitfall to avoid on your journey to financial success. Mistake number 2, trying to time the market. Another term for market timing is trading, specifically when done with the intention of outsmarting the market and profiting from short-term price fluctuations. It involves actively buying and selling securities based on predictions of future price movements, rather than a long-term investment approach. It's a common pitfall, tempting even seasoned investors. The allure of predicting market movements and capitalizing on short-term fluctuations is strong, but often leads to disappointment. The idea of buying low and selling high sounds great, a simple concept in theory, but even the pros, with all their sophisticated tools and analysis, can't do it consistently. They dedicate their careers to understanding market trends, yet consistently timing the market remains elusive. Markets move on unpredictable news, events, and emotions, a complex interplay of factors that are impossible to foresee with certainty. Geopolitical events, economic reports, and even investor sentiment can trigger sudden shifts. No one can predict it all. The sheer volume of information and the speed at which it travels make accurate predictions incredibly difficult, if not impossible. Most who try to time the market end up selling low and buying back in too late, often driven by fear and greed. They react to market downturns by selling only to miss the subsequent rebound, missing the best days. These periods of significant growth can dramatically impact your overall returns, missing just a handful of the market's best days. Even a small number can cut your returns in half. It's a steep price to pay for trying to outsmart the market. The smarter move? A more strategic and less stressful approach. We want to put time into the market, not trying to time the market. Focus on long-term growth rather than short-term gains. Use dollar cost averaging, a proven strategy for building wealth over time. Invest a set amount regularly, consistently contributing to your investment portfolio. No matter what the market's doing, whether it's soaring or plummeting, stick to your investment schedule. This smooths out your purchase price and removes guesswork. You buy more shares when prices are low and fewer when prices are high, averaging out your cost per share over time. You don't need to be glued to the news, constantly monitoring every market fluctuation. Just be consistent. Regular, disciplined investing is the key to long-term success. Automate your investments, set up automatic transfers from your bank account to your investment account, and let the market work for you. Take a hands-off approach and allow your investments to grow over time. You'll never buy at the bottom or sell at the top. It's virtually impossible to perfectly time the market's peaks and valleys. And that's okay. Don't strive for perfection. Focus on consistent progress. The goal is steady growth, not perfection. A consistent upward trajectory is far more valuable than trying to catch fleeting market highs. Consistent investing captures the market's long-term upward trend. Historically, the market has consistently trended upwards over the long term, rewarding patient investors. Don't chase quick wins. Avoid the temptation of get-rich-quick schemes and risky trading strategies. Focus on building wealth over time. A long-term perspective is essential for achieving your financial goals. Except you can't predict the future. Embrace the uncertainty of the market and focus on what you can control. Control what you can. Focus on the factors within your control, your savings rate, consistency, and patience. These are the cornerstones of successful long-term investing. Set it and forget it. Automate your investments and let them grow without constant monitoring. And your future self will thank you. The rewards of consistent long-term investing will be realized in your retirement years. Mistake number 3, ignoring the fundamental principle of diversification. It's a concept that might seem simple on the surface, but its importance cannot be overstated when it comes to building a resilient and successful investment strategy. It's about more than just avoiding the cliche of putting all your eggs in one basket. It's about understanding the inherent risks of overconcentration and actively mitigating them. Many beginners, often fueled by excitement or a tip from a friend, bet everything on one single stock or a specific sector they believe is poised for explosive growth. This approach, while potentially rewarding in rare cases, is incredibly risky and exposes your entire investment to the fortunes or misfortunes of a single entity or industry. Diversification, on the other hand, means strategically spreading your investments across a wide range of different assets, sectors, and even geographic regions. The core idea is that if one part of your portfolio experiences a downturn, other uncorrelated assets can help balance it out, cushioning the blow and preserving your overall capital. Think of your investment portfolio like a well-rounded sports team. Different players with different skills and strengths, each contributing to the overall success. You wouldn't want to rely solely on one star player. And similarly, don't let one company's bad news or a sector-wide slump wipe out your hard-earned savings. History is full of examples of once great companies that seemed invincible, only to crash and burn due to unforeseen circumstances or disruptive innovations. By diversifying, you're essentially building a protective shield around your investments, smoothing out your returns over time and significantly reducing your exposure to catastrophic losses. While you might not hit a spectacular home run with every investment, you'll dramatically increase your chances of avoiding catastrophic losses and achieving long-term sustainable growth. For beginners, a simple and effective way to achieve instant diversification is through index funds or exchange-traded funds or ETFs. For example, an S&P 500 index fund automatically gives you exposure to the performance of the 500 largest publicly traded companies in the United States in one single move. To further enhance your diversification, consider adding international funds to your portfolio, providing exposure to markets and economies around the globe. As a general rule of thumb, if more than 10% of your investment money is concentrated in a single stock, you're likely taking on too much unnecessary risk. Resist the temptation to chase the next hot stock or the latest investment fad. Instead, focus on building a boring but well-balanced portfolio that aligns with your long-term financial goals. Diversification might not be the most flashy or exciting aspect of investing, but it's arguably the safest and most reliable path to building lasting wealth over time. Take the time to carefully review your current portfolio and make sure you're adequately diversified, spreading out your bets across a variety of asset classes and sectors. By embracing diversification, you're taking a proactive step towards protecting your financial future and ensuring that your money remains safe and continues to grow steadily over the long term. Mistake number 4, letting emotions drive your investment decisions. Fear and greed are powerful forces that make investors buy high and sell low. Greed strikes during bull markets, and FOMO, fear of missing out, makes you chase hype and overpay. Plain fear takes over during downturns, leading to panic selling at the worst time. Both can wreck your long-term results. The solution? Stick to your plan, especially when emotions run high. Automate your investments so you're not tempted to react to every market move. See market dips as opportunities, not disasters. When stocks go on sale, it's a chance to buy quality assets at a discount. Successful investing is about discipline, not drama. Don't check your portfolio every day. Avoid emotional roller coasters. Remember, the market rewards patience, not panic. Stay rational, stick to your plan, and let time do the heavy lifting. The patient investor wins in the end. Don't let a moment of fear or greed undo years of progress. Keep your cool and stay the course. Mistake number 5, overlooking fees and costs. High fees quietly eat away at your returns, costing you thousands over time. The biggest culprit, expense ratios on funds. Even a 1% fee can cost you over $100,000 in lost growth over decades. Always check the expense ratio before investing. Aim for funds under 0.2%. Watch out for trading commissions, account fees, and hidden charges. Today, there's no reason to pay high fees. Many brokerages offer low cost or free options. Every dollar you save on fees is a dollar that compounds for you. Think of fees as a guaranteed loss. Minimize them wherever possible. Compare similar funds and choose the cheapest option. Don't let hidden costs drag down your performance. Be a fee detective. Scrutinize every investment. You can't control the market, but you can control what you pay. Lower costs mean higher returns, risk-free. Make minimizing fees a habit from day one. Your future self will thank you for every dollar saved. Okay, I'm running out of time. Let's move on to another critical rookie mistake. Number 6, failing to do your homework before investing. Don't buy based on hot tips or social media hype. Investing without research is gambling, not strategy. Understand what a company does, how it makes money, and its basic financial health. You don't need to be an expert, but read the basics. Annual reports, products, and competitors. For most beginners, index funds are a safer bet. They spread your risk and require less research. Still, know what index your fund tracks and its fees. Invest in what you understand. Build conviction in your choices. If you can't explain your investment to someone else, you haven't done enough research. Smart research leads to confident long-term investing. And finally, mistake 7, neglecting your long-term goals for short-term gains. Chasing quick wins leads to risky moves and impulsive decisions. Real wealth is built over decades, not days. Focus on goals like retirement, college funds, or financial independence, not doubling your money next month. With a long-term view, short-term losses become minor blips. Market crashes are buying opportunities, not disasters. Avoid day trading, leverage, and penny stocks. These are fast tracks to losing money. Don't check your portfolio daily. It only fuels anxiety. Stick to your plan and invest consistently. The most successful investors are patient. They let compound growth do the work. Write down your long-term goals and keep them visible. When markets get rough, remind yourself why you started. Don't let short-term swings derail your future. Patience and discipline are your greatest allies. Stay focused on the big picture. So, there you have it. The top 7 rookie mistakes to avoid as a new investor. Building wealth is about discipline, not genius. Have you made any of these mistakes? Share your story in the comments to help others. If you found this helpful, hit like and subscribe for more simple investing advice. Join our community of smart, patient, and lazy investors. Thanks for watching. Watch this video next, and I will see you in the next video. Stay lazy and let your money do all the work.